There are countless mistakes that are made on a regular basis in many different things in life, and in this video I'll cover some of the top trading and investing mistakes beginners make. And you make sure to watch all the way till the end, since the last one, well, there's a good chance you're making it as we speak. So the first point is thinking it's simple. Usually people that are just beginners in the stock market or in any market out there think it's super easy and super simple to make money. Trading, investing, whatever. I'm looking at you, crypto fans. But for the matter of fact, it's not that easy. There is one way that can be looked at as easy to invest in the market, and I would say it's DCAing into an index fund and just riding the wave with the market as a whole. For instance, the S&P 500, which in the past few decades brought an average of around 9% return on an annual basis. But remember, past performance does not indicate future results. But what if you're not about that life and you want to try and make 15, 20, 100% or even more return on your portfolio on an annual basis? Then what? That's when things become complicated. And as many things in life, you will have to take on more risk to try and reap higher rewards. Trust me. So if you want to try and get to the higher tier of investors and traders that beat the market on a consistent basis, well, then you must try and be ahead of the curve all the time. What does that entail? Well, you have to understand financial statements, how different announcements can impact the analyst's consensus on a certain stock or stocks, or even whole markets. You need to know and understand fundamental and technical analysis and how to analyze a stock properly. You must follow the news of many companies to find out which one might be the next big thing and bag you 20% return in one day. And this is just the beginning. I won't get into all the things you need to do to be successful on the market, and the bottom line, it's not simple or easy to be successful on the market, at least not as easy as it seems to be. But don't misunderstand me. Even though it's not easy and certainly does not fit everyone, I like it, and maybe you'll like it too. You'll never know if you don't try. But then again, trying with a paper account, which is an account without real money, can definitely save you some money and maybe some time, since trading on the market bears a ton of risk. I'll link an awesome broker I use in the video here somewhere, so if you want to check it out, click and open an account with them. It's free and they're really awesome for beginners. Off to the next thing. Getting overwhelmed with information. In today's world, there's a ton of information online about everything. For example, if you want to cook a roasted chicken, you'll probably find 20 different recipes on Google on the first page before you got the chance to even scroll down. Same thing goes for stocks. If you Google a company like Apple, you'll probably find a ton of articles and different opinions about the company and the future price of the stock. Some will be talking about the stock going up, some will be talking about the stock going down, and this is when your own judgment should come into play. When I analyze a stock, a market, whatever, I try to look at all the information objectively for a simple reason. When people are saying XYZ stock is amazing and it's probably going to go up, well, I assume they already bought it. And of course they'll advocate for it, so their opinion is biased and therefore can't be trusted, plain and simple. Same thing goes for all the gloom and doom analysts claiming that this or that stock are going to die. I automatically assume they have a massive short on it. And that's why when analyzing assets, stocks, whatever, analyze, come to your educated conclusions, assuming you know how to analyze, and act upon your own opinions, not by something someone wrote online. Third point, panicking or getting excited and thinking you know it all. Well, at the time of this video recording, we are officially in the bear market, and we're more than 20% down from this year's high. Beginner investors and traders tend to panic when big unexpected things happen, especially if this is the first time you start losing money. This happens. This is part of the game. Let me give you a small example. When COVID-19 started and the markets dropped like a rock, we all know that the Fed saved the market by injecting huge amounts of money into the economy and the market. And that helped the stock price increase like never seen before. And seemingly everyone was making money on the market. So everyone is an investing or trading guru now because he bought Tesla and made 600% return on his investment. Well, now when the markets are dropping and we're in a bear market, these investors and traders are panicking more than they were excited when everything was going up. And in this case, proper market education and risk management can help. The way to avoid this whole headache and panic is to study and implement risk management so you never have to panic when the market or a stock goes against you. And the overall experience of investing or trading can be more predictable when you know exactly how much you stand to lose if things go wrong. And now for the fourth and last point, thinking your stock is worth more than it's actually worth. Here we are heading towards the psychology of trading a little bit. This is a fascinating subject, which I'm thinking about making more videos about in the future. But comment down below if you think it's a subject I should talk about more. Alright, so here's the thing. If you think you've fallen head over heels for a certain stock and think it's worth much more than the current price, remember, it's a company with a product. Nothing more, nothing less. And if someone else doesn't like this stock and think it's not worth what you're thinking it's worth, no need to get upset or even mad at that person, news outlet, or even Jim. So why does it happen? We all have emotional biases that are inherited into every single one of us. And this one is called the endowment effect. And what it does in a nutshell is give the person that's holding or owning an object a higher and often irrationally more value than its actual value, just because it's his or hers. What it does is essentially cloud the judgment of the individual into believing a stock is worth more than the current price. And that's why you're not selling it, when in fact the stock is way overpriced and will probably crash soon, while you live in a fairy tale that it will explode in value even more and make you rich. I'm sorry to burst your bubble, but it's not worth as much as you feel it's worth. Stick to the numbers and to your analysis, and remember, anytime a stock or an asset makes you feel all fuzzy in your tummy, it's probably time to reanalyze it and maybe even sell it. Because if you really love them, you have to learn to let them go. And don't forget, you can always go back in. I hope you learned something new today, and if you did, please subscribe. Keep on profiting, and see you later.